Hello, everyone. Today on the Final Bar, happy Monday. We'll talk about this market having a decent sort of push to the upside. The Nasdaq leading the way higher. The mega caps, not necessarily the story today. It's about other things. Some M&A activity, also nice recovery from some beaten down banks. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Happy Monday. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny and hot Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. Our platform, StockCharts.com, was designed just a couple years ago, about 24 years ago, to help and empower individual investors, online investors, to make better decisions. Sort of came onto into the world in the sort of mid to late financial crisis or tech bubble, and from there we've continued to build up our capabilities to more and more address the changing market environment. We find a lot of people are using tools analyzing breadth and sentiment, trend and momentum. We try to give you those tools to access as easy as you can. On a day like today, and really in recent weeks, we've been talking about sort of this sideways, choppy environment. And again, today, sort of lower volatility, sort of drifting higher. But, again, a couple interesting observations about today's action. Number one, materials was the number one sector. There's some M&A activity with Newmont Mining and a couple others involved, which is causing some of those stocks to move to the upside. Mega cap tech communications names, those FANG stocks, not all of them having a particularly good day. Some of the FANG stocks actually down today while the markets were actually pushing higher. So a bit of a different narrative than we've seen from recent weeks. However, the general theme is still the same. Can these stocks, can these indexes get above resistance levels? And for now, we're still waiting, although more and more we're finding individual stocks that are able to do it. And we'll try to highlight some of those here today as well. Let's get right into our market recap if we could and talk about some of these patterns and movements that we're observing through the course of trading today. As I mentioned, the major averages having a decent move to the upside by the end of the day. S&P and the Nasdaq finished toward the highs of the day. S&P up about 1/3%. The Nasdaq Composite up 2/3%. So while the Nasdaq Composite has made a new high for the year, continuing to push that higher today, the S&P still not quite there. 4,200 sort of that main level we're looking for. If and when the S&P can get above 4,200, which I think undeniably at some point it will do. I just don't know if that's tomorrow or a longer ways off. However, for now, we haven't quite done it yet. But again, underneath the hood, you're finding some interesting movements, which, again, we'll try to highlight here through our recap. Mid caps and small caps up as well. Another bit of a diversion from the recent narratives we've been talking about. Small caps actually outperformed today. The small cap S&P 600 index up about 1%. The VIX moving higher as well. So this is one of those unusual days where you have the market moving higher and volatility increasing. That's not like that's not allowed to happen. It's just a lot less common, right? Markets tend to move lower on higher volatility because you think of volatility, the VIX is the fear gauge, right? A measure of uncertainty. So generally speaking, markets tend to move higher on lower volatility. They tend to move lower on higher volatility. But for today, the VIX actually pushing just a little bit to the upside, just above 17. Let us look at some of the other asset classes and see what we can find. The yield curve here, we're looking at fixed income markets, 5, 10, 30-year points, all moving a little bit higher. And what that means is basically bond prices came down. You can see the TLT, which is fifth on the list here, down about 1% to 103.20, a little bit below there. 5, 10, 30-year yields all moved higher. The 10-year yield back above 350 to around 351. The dollar index down by about 1/3%, not too much to the downside. But overall, one of those key things we've been talking about is the level of the dollar. Number of my guests recently, we talked about the dollar weakness and what that has meant for risk assets. I would certainly be watching the dollar because any big uptick that you would see in the dollar, probably not a great sign for stocks. But again, that's a pretty big generalization. Commodities overall, a lot of green on this list here with the DBC, which is a broad commodity ETF, up about 1.1%. Gold and silver prices both moving to the upside, but not by much. Crude oil prices having a decent day with the USO up 1.5%. Natural gas, the best performer out of this group of 8 commodity ETFs. Finally, in cryptocurrencies, we talked on Friday's show about this potential breakdown in the price of Bitcoin and in Ethereum. A head and shoulders top, pretty clear on a short-term time frame. Really, it was only about a month long, maybe a little bit less. But breaking down through that neckline, measured a little bit lower. Actually seeing a nice rebound over the weekend today as well, pushing to the upside just a bit, with Bitcoin up 1.8% from Sunday's end of day, and then Ethereum prices just around 1830. Sector-wise, let's look at the sectors and where they moved. As I mentioned, materials actually number one. That's actually pretty uncommon. We haven't had materials at the top of the list in a while that I can remember. We've talked about the strength in gold stocks and some of the precious metals names, but as a sector, materials has not been particularly a leading sector. It's usually been some of the more defensive stuff like healthcare, real estate, or something more growthy like a technology or consumer discretionary. Today, the XLB was the top performing ETF, just narrowly edging out the XLK, technology, and financials. All of them were up about 0.8 to 0.9%. On the downside, you have the defensive sectors for the most part down here, with utilities down the most, around 1.25%, consumer staples, real estate, healthcare, down about 0.2 to 0.3% overall. Let's look at a daily chart of the S&P 500, see how today's sort of nice drift to the upside fits into the big picture. And here's the problem, right? It's when you look at the short-term movement, what happened today, you get some of these little themes like, all right, something's starting to rotate higher, starting to see some improvement in breadth. But again, on the longer term, the medium-term, longer-term time frame, I would say still not enough to sort of really push the direction of this ship one way or the other, right? We've been in this sideways market really since the end of March, right? This rally off the March low, stalled out just above 4,100. From then, we've been really rotating above and below sort of 4,100, 4,150, and we're sort of right in that middle of that range. So again, in a period like this, I think it's important to just take a sense of where we're at, look to the left, and see how much time we've been spending right around this level. And, common way to think about this is the longer we spend in this basing pattern, the break, either way, is most likely going to be a significant one, because it will finally be enough momentum to exit this trading range that we've been in for quite some time. So I think the key levels remain, as we've talked about. Over 4,200 is a pretty bullish development. What's interesting is you'll find certain places, just to move aside just for a brief to digress, we have the technology sector, the XLK, making a new year-to-date high today, right? Getting about 0.8% to the upside, leading the markets up there just behind materials, above the 50-day moving average, making a new swing high. Clearly above the August high now, more and more as we push higher, but making a new year-to-date high. So compare that chart to the chart of the S&P that's just sort of not quite there. And again, that tells the story of the broader story within the equity space. Is you have some strong areas within growth, you have some more weakened and challenged areas within some of the value sectors, and it's netting out to our major benchmarks sort of sideways. I wouldn't tell you that doesn't mean there aren't plenty of opportunities out there. We just have to make sure that we look where to find them. Just briefly on some of the other charts that I think tell a great story about the overall conditions here. We highlighted this one, I think, on Friday's show, but just look at the advanced decline line, cumulative advanced decline line for large caps, for mid caps, for small caps. And I would say the large cap one, pretty good, and looks very similar to the chart of the S&P, which makes sense. The mid cap AD line actually broke below its 50-day moving average last week. And if and when it regains that, I think that becomes a little more positive. But for now, really accentuating the short-term weakness in the mid-cap space. Then we have small caps in a clear downtrend, actually failing to get above its 50-day and making a new low for the year, potentially this week. So you have a real difference between the large and the small names in the S&P and what that, or in the S&P 1500, in the larger group, and what that might mean. Now, if you take the advanced decline data as one indication of breadth, we can use the McClellan oscillator, which uses the advanced decline data, but runs some moving averages on it, some exponential averages to make it a little more of an oscillator. So this is sort of like an RSI for the market, but it's using this measure of breadth, right? Using the advanced decline data and smoothing it out over time with some moving averages. Again, we've been below zero since the third week in April. We had one day where we kind of popped above there, but that's happened a number of times. Overall, you really need to see an improvement above this zero line. Look at what the performance of the S&P has been when the McClellan oscillator is shaded in red, meaning it's been below zero. Look at how much more positive it's been when the McClellan oscillator has been above zero. This is why it's important for the oscillator to get it back above zero. And again, it's not a causal thing. It's not telling you once we get above zero, that means the market can go higher. It's just measuring the breadth of the stocks that make up the S&P 500. Really, it's a broader list of the New York Stock Exchange listing. So when the average stock is doing well, the market tends to do well, and we're not in that particular condition here. So when I think about what would cause me to be a lot more optimistic, a lot more bullish about upside potential, the McClellan oscillator getting above zero, the S&P getting above 4,200, broader participation, broader upside momentum, or stronger upside momentum. Those are certainly the things I might be looking for right about now. Looking at other asset classes here just for a moment, I wanted to highlight one ETF called LQD. I always tell people, if you're not familiar with fixed income, you have the TLT, which is sort of treasury bonds. And again, it's one part of it, but that's a good proxy for sort of long-term treasury debt. You have the LQD, which represents corporate debt, so the debt issued by companies. And then you have the AG, which basically looks at all of that together. Treasuries and corporates all in one big ETF. I just want to highlight the chart of the LQD because over the last 6 to 8 months, it's had some brilliant bearish and bullish momentum divergences that have really shown the rotation within the fixed income markets. In September and October of last year, we had the LQD make a new low, a new 52-week low on higher momentum. That's a classic sign of a bottoming, potential bottoming phase. We rallied off of those levels in December into January and February, higher highs with lower peaks in momentum, telling you upside movement probably exhausted. And then look out from there, we sold off down to retest the December low. Now we've rallied up to test the January, February highs. And now we're sort of in the middle again. So similar to the S&P 500, I think the bond markets are sort of in that sideways phase as well. One of our questions I hope we can get to today asks about that ratio of stocks versus bonds. So I'll save any further comment for that question, which I thought was a brilliant one to highlight. Just to finish off with a stock or two, then we need to take a break. In terms of names on the move that I think you might want to be familiar with, Tractor Supply Company, really up until about a month ago, one of the better charts out there. And within the consumer discretionary space, when I'm seeing the outperformance of the defensive sector of consumer staples, in my mind, I'm thinking of a chart like TSCO, which is making a new 52-week high in mid-April. All of a sudden, we go to mid-May, and while it's not totally broken, we're still sort of in an overall uptrend. We are pulling back a little. We've made a lower high around 245. Today, selling off about 3.5%. That brings us below the 50-day moving average. Over this sort of rally phase off of the October low of last year, pullbacks to just below the 50-day moving average have quickly been bought. You've seen buyers come in, you've seen demand increase, and you've seen the price go right back above. Is this time different? One cause for potential concern is the fact that we've already made a lower high, which could be an issue. So at this point, the breakdown for now is a bit of a concern. Can we get back above 245? That would mean, brief pullback over. Most likely we retest the highs, if not more. But that is a big if, as the RSI is also testing 40, which is usually where in a bull phase that stocks will tend to pull back. Folks, let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. So excited to bring you the show again today and all week here from our live from our studios here in Redmond, Washington. A couple quick announcements before we answer questions from our Final Bar mailbag. First off, I wanted to let you know the mailbag is fueled from questions from people like you. If you could email us any questions you run into as you are analyzing charts and stocks using the StockCharts platform, our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Just put a comment below the video you're watching on our StockCharts YouTube channel. We'll hope to answer your question live on the air on Friday's show of this week. Upcoming schedule, super excited. Tomorrow on May 16th, Tuesday, we'll have Danielle Shea of Simpler Trading live from our studio here in Redmond. She'll be coming into town. It'll be a lot of fun to sit down with her, as we did with some of our guests a couple weeks back, and pick her brain about some of the top charts of the day. The day after that, on Wednesday the 17th, we have Jesse Felder, editor of the Felder Report. On Thursday, May 18th, Mr. Seasonality, Jeff Hirsch, editor of the Stock Traders Almanac. We'll see what he thinks about the whole sell in May phenomenon. Is this a year where that's going to be engaged, yes or no? We'll talk that through with Jeff Hirsch. Let's continue on our show today with the Final Bar mailbag. Thanks so much for all the great questions you've been sending in. Keep them coming. We selected some of them to answer, and here's question number one. Would you revisit DuPont once a week to follow up on the head and shoulders pattern? This was something we talked about on the show last week, if I remember right. My short answer is, of course. So I want to start that today and just show you where we're at with it. You bring up a good point. This is something I do with my premium members of Market Misbehavior. You take one chart or a series of charts and you follow them very closely over time. And it's sort of an ongoing case study to see how the analysis shifts. And I would tell you one of the great tools, or one of the great techniques I learned from technical analysts successful over a course of a long career, is they have a very consistent process. They just look at the same charts very consistently. And that was an important takeaway of mine early in my career, and has led to things like my morning coffee routine, all driven off of looking at a similar list of stocks every day and just making sure you recognize those changes. So we highlighted this gap lower that confirmed what I would consider a pretty classic head and shoulders topping pattern, the high surrounded by lower peaks. I've notated this on the chart, and you see the breakdown of the neckline here. So what's funny is, since we've gapped lower and gapped right below the 200-day moving average, we've sort of stalled out, right? So there's not really any further deterioration, but no real improvement. And I think that might be an important note as well, right? The downtrend for now has paused, so that's encouraging if you're worried about some further downside in the stock. We haven't really seen it yet. But buyers really haven't come in, right? The price goes higher if you see investors willing to pay $65.50 or so for DuPont and pushing the price higher and higher. For now, we've just seen it chopped around. We closed just above the 200-day moving average. That would have to start, but for now, it's still sort of waiting. So what would change the configuration here? For now, I would argue the path of least resistance probably remains lower, given the downtrend and the breakdown of the head and shoulders topping pattern. What would change that, and what we will revisit to see if those conditions change, will be, number one, getting back above the neckline. That's usually one of the first things that happens. Number two, can we get above the 50-day moving average, which is a really nice way of tracking that right shoulder as we rolled over and kept making lower peaks. Finally, can we break a trend line? So you draw a trend line using the head and the right shoulder. That's one of the things I often look at just to see and set an alert to see if we can get above there. Those three things, and all of a sudden this chart looks very different and much more improved. For now, though, I think the path of least resistance, overall, again, based on all the things we talked about, no real change yet, but absolutely, I'll put it on my list. I'll set a reminder, maybe occasionally, we'll see what frequency I can get to. We'll revisit that chart of DD. And thanks so much for that question and that suggestion. Next question, as gold, and this is a great one, as gold goes up, what sectors would you expect to rise or fall, and why? So there's so many things I would love to talk about in reaction to your question. First off, I really appreciate it. There's a simplicity to your question which I don't want to put down at all. I think it's a great way of thinking of it, which is, if gold is doing X, what do these other stocks or sectors or things do? And not just sectors, right? But what about the markets as a whole? And trying to come up with that relationship. Here's the problem. As much as you would like to think of it that way and think if gold goes up, what sectors would tend to do better or worse, it is just super not that straightforward. And as an example of that, I created this chart before we went live with the show just to show you. Here is the last, what do I have, 5 years of data, of daily data. So 5 years, daily data. This is gold, the gold futures contract, continuous contract in the top panel. We have the S&P 500 on log scale in the second panel. Then at the bottom, I have a rolling 1-month correlation. So it's a 20-day correlation. How closely, or how would you define that relationship between gold and the S&P? What's the average level of this correlation going back for the last 5 years? I would hesitate to guess anything much different than zero, and if not exactly zero, very, very close to zero. And what that means is there are periods when stocks and gold move very, very closely together, right? Where stocks are moving higher and gold is moving higher. Just visually, you can see that like in mid-2020, right? This is coming off the 2020 low. You can see gold and the S&P both bottomed out in March. You can see they rallied, consolidated a little bit here for gold, and then moved higher. And in that summer session, you saw that gold and the S&P actually moved upwards together, which means their correlation is pretty high, about a 0.8 positive correlation. That's pretty decent. But you will find other things. You don't have to look that far to see periods like the beginning of 2021, where stocks continue to rally. All of a sudden, gold rotates lower. So you see gold moving completely opposite to the S&P, and you can see the correlation goes well below zero, back to kind of a strong negative correlation. The challenge with gold is it's just not as straightforward. It's not like an inverse relationship like the S&P and the VIX that we like to talk about. Now, before you go saying, all right, well, that's a horrible thing that you can't come up with a correlation, that's actually why investors appreciate gold so much. It's what you call a non-correlated asset. if you're an institutional money manager, you love things like this that are going to diversify away from the market, right? If I want to perform differently than the S&P, something like gold, which has a very differentiated return stream, meaning it's doing different things and it's a little less predictable relative to the movement in equities, that can have a lot of value because it diversifies you around different periods of time. So a lot of times people talk about gold as a safe haven, as an inflation hedge. There are times when that absolutely is the case. There are plenty of times when that actually is not the case. And as an example, look at 2022. If gold was a safe haven, I would expect 2022 would have been a banger year for gold, and it certainly was not, right? Until the fourth quarter, when stocks were already rallying, it was actually a pretty tough place to be as well because the dollar was so strong during that period. So the short answer is I'm not comfortable making any sort of relationship. I think if you look for the correlation between gold and any of the 11 S&P sectors, I think you'd be hard-pressed to find any strong relationship that is consistent. You'll find a lot of inconsistencies, but again, that is a benefit, and I think that's a reason to think about gold in a diversified portfolio. Just don't just think about it as stocks and bonds. Things like gold and real estate that are diversified in terms of their return profile can be really, really helpful and help you navigate some of those uncertain periods. Thank you so much for that question. I hope that chart sort of helps you understand the relationship or lack of relationship a little bit better. Next question, how do you play a chart like LMT, that's Lockheed Martin? Let's bring this one up and take a look. So of course, standard disclaimer, I'm not here to recommend anything, and please do your due diligence and talk to a financial professional if you like. But when we're looking at the chart of LMT, so a couple observations on this chart. Number one, it reminds me of other stocks in the industrial space that, again, a month ago looked fantastic, right? I'm thinking of Tractor Supply Company in the back of my head as well, right? There's a chart we reviewed earlier that a month ago, this was a space, and I would put some of the defense stocks in that same group as just breaking out, right? Making a new 52-week high the second week in April. That's not too bad. I mean, that's a nice move and breaking out of this range. When you ask me about what concerns you about upside potential for this market, it's not, anything about the FANG stocks. It's not the mega cap names. It's charts. That was a horrible draw of a horizontal line. There we go. If you take a chart like Lockheed Martin and go back to Technical Analysis 101, a big basing pattern, we break to a new high, that's a pretty high probability buy sort of pattern, right? That's a bullish breakout above resistance, but it didn't follow through, right? You had a couple days, we pulled back, we had a gap higher, it never followed through. We never had those follow-through days, which is a rally and then continued buying, showing you that there's additional demand beyond that initial buy point. Never really played out, right? So even that gap higher, that was it. We just kept closing lower for the next week straight, if not a little bit further. So that sort of bullish breakout thesis is now gone. We're now back below the 50-day moving average. If there's one thing I would certainly be looking at, it's the fact that we're at an ascending 200-day moving average. Now we're chopping around there. We broke down below there about a week ago and haven't gone much further. So for now, I'm looking at this as a potential good, signal that we might be rotating higher. Is this the lower end of this channel before we rotate back to the upside? What's great, and I would say on this chart, there's not enough to tell whether that 200-day is going to hold, maybe like it did more in January of this year. But I would tell you an indicator like MACD or PPO, perfect for this sort of chart, because what that can often tell you is there demand on a name like this? So on a chart like Lockheed Martin, what I like to do is go to the alerts. Don't use a price alert, but use the advanced alert and get an alert when the MACD or PPO indicators give a buy signal. That's a really good way to follow a chart like this. And just make sure you don't miss if there is a nice rally off the 200-day. For now, we haven't quite seen it yet, so I think we wait and see at this point. That's how I would break down the chart of LMT, and thanks so much for sending that. Next question, what is the ratio of stocks to bonds, SPY to TLT, really telling us? And that is a paraphrasing of a long question that you sent me, and I really appreciate it, going through a lot of different items and talking about stocks and bonds. And I had shown this ratio not too long ago, so let me get back to it. I think on my Mindful Investor chart list, I have that. Pretty sure that's the case. So let's look here. It's going to be something like this one, stocks versus bonds. I don't know if this is the exact chart, but I think it might have been. And I was showing this ratio over time. This is just a simple ratio of the SPY divided by the TLT. So if this line is going up, stocks are outperforming bonds using this, these tickers. If the line's going down, it's underperforming. So what's the overall take? My comment on here is that even with uncertainty in stocks, 2021, a bull market for stocks, 2022, a bear market for stocks until the fourth quarter, 2023, sort of an open question, but overall netting out more positive than negative. this ratio really hasn't gone down to the point that the larger trend seems in danger, right? You've had these brief pullbacks of a couple months, which have certainly been a rotation away from stocks and into bonds for that period. But if you look at the overall trend, my point of this was saying the long-term trend remains positive. One thing I think you mentioned in your question was this, which you might call a triangle pattern. I can't disagree with that. I mean, it's not the most perfect one ever, but I get the idea, right? We rallied, we've then sort of consolidated where stocks and bonds have been even. We're kind of breaking above the upper boundary of that. I would 100% agree. And I think that, again, what for me, the general sense of this chart is that stocks are outperforming. Now, the point of your question was, does that mean that more money is coming into equities versus bonds, or is there some other measure of activities? So the couple of things you can do when you're trying to look at fund flows, right? You can look at price, and the good thing about ETFs is the price are driven by supply and demand. So if you have additional demand for the SPY, the price of the index is going to go up. Additional demand for bonds, TLT, the price goes higher, and overall that tends to match pretty closely the demand for shares. You can also look at fund flows and actually look at funds flowing in and out of ETFs. That's a whole other way of thinking about it. For simplicity, I think price is a really good way to use it. I think one of the great benefits of being a technically oriented investor in 2023, pretty much everything has a ticker at this point, and it's a relatively liquid ticker at the very least. It's a great way, whether or not it's liquid enough to trade, it's certainly liquid enough to measure the performance and the trends in these different asset classes. So overall, this ratio going higher just tells me to continue to lean into stocks over bonds, all else being equal. Thanks so much for that question and for all the others, but we need to wrap this show, folks, and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Let's get to chart number 1. Our first chart is looking at Japan. We're going to go outside the U.S. here very briefly. I was realizing over the weekend, I was sharing this chart with my premium members at Market Misbehavior, and it came to my thinking over the weekend that I really hadn't shown a lot of international markets on this show too often. So I just wanted to highlight the chart of Japan here. And I brought this up because China is actually breaking down last week. You had charts like the EWH, FXI, others either breaking down or at the lower end of their range here of recent months. But as a balance to that, you see Japan actually breaking higher. What's fascinating about this market, again, even with our major averages struggling, again, the Nasdaq Composite certainly seeming to follow through to the upside. Note that there are markets out there that are rotating just fine. There are stocks that are breaking to new 52-week highs. If you use our scanning engine, our alert system, your chart lists effectively, you're not going to miss some of these things that are actually making new swing highs and new swing lows. I came up with EWJ last week as I was scanning for ETFs making new 3-month highs and 3-month lows. This popped up, and I dug into it a little bit further. I think that's a nice breakout above resistance. EWJ continues to hold 59. That's a pretty strong chart and maybe a good opportunity to diversify away from the U.S. As another non-U.S. name to get to, and I feel like the head and shoulders pattern has come up so much recently, and maybe that's a sign of the times, because a lot of times you don't see a lot of them. We're certainly seeing a lot of them right now. This is Telefonica Brazil, which is ticker VIV. I'm showing the unadjusted version here because it's a higher yielding name, and I just want to strip out the dividend component, look purely at the price action. I'm doing that to show what looks to be a pretty classic head and shoulders bottoming pattern, or an inverted head and shoulders pattern. You have the low surrounded by higher lows. We have the neckline connecting the interim highs. We can see we broke above the 200-day, broke above the neckline, pulled back, and then rotating higher. Just a nice classic breakout, retest, and then rotation to the upside. So I'm encouraged, even though I think the major averages, particularly the S&P, still has more to prove. I'm finding charts that seem like they don't have more to prove, that they've already proven that they're breaking out. Again, as I've mentioned many, many times, it's always a good time to own good charts. Think about the macro environment, the big picture as one part of your process, but never be afraid to consider strong charts in any environment would be my general approach to how to think about this. Final chart out of our 3 in 3 is Danaher, DHR. This is a medical equipment name, and a number of medical equipment stocks came up on my new swing lows list. This is actually making a new 3-month low last week, continuing to chop around today, just down just a little bit below the zero line today. But the weekly chart of the S&P shows of this stock, DHR, shows a rotation from a rally really into the third quarter of 21 to more of a downtrend. Look at how we've now broken down through support, broken down through the 150-week moving average. So overall, a beautiful illustration of a rotation from an accumulation phase to more of a distribution phase. Look for that trend to change before you get too excited about the upside potential in a chart like that. Folks, that's a wrap for the show. Thanks so much for joining us on a Monday for the Final Bar. All of our previous interviews and discussions can be found at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good night.